Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. The next VRIC is January 21st and 22nd. You can get your tickets in the link in the description below. But for now, we're bringing the VRIC to you with our series of expert online panels. And we have another great one for you guys today, all about uranium. We're speaking with Justin Huhn of Uranium Insider and Fabi Lara of The Next Big Rush. Welcome to the show, guys. It's an honor to have you on.
Pleasure to be here. Thanks, Jesse.
Thanks for having me again, Jesse. Pleasure to be here.
Yes, I'm very excited to chat uranium. We've done individual interviews together many times, and I think both of you have a lot of great points when speaking about the sector. So let's start with a tweet you made, Justin, that the year-to-date total of long-term contracted uranium stands at 143.7 million pounds. How does this number stand historically? And do you both expect more action in the term market before the year is up? And I'll send it to you first, Justin.
Well, this year so far, year to date, has been the most number of pounds contracted in the term market on an annual basis for more than a decade. So this sector tends to operate in these very long-term cycles. Well, there will be multiple years where utilities will contract less than the replacement rate. So the replacement rate essentially is the annual burn-up rate of uranium by the global nuclear reactor fleet. And depending on the tails assumption for enrichment, that's anywhere from 430 to 460,000 pounds per gigawatt per year for a basic light water boiling water reactor. So, which is most of the world's fleets. And so you'll have many years of 80 to maybe 120 million pounds contracted, even less than 100 million pounds for multiple years in a row. And the utilities will draw down inventories and bolster their inventories with short-term spot market purchasing. That worked for a long time, especially in the previous decade, where we had an incredible amount of above ground mobile inventory, where the utilities didn't have to go to the term market. They could buy cheap spot market pounds because the term market essentially is beyond 12 months. And typically a utility will go directly to a producer to secure those pounds in the term market. And now that the market has shifted so significantly, utilities are coming back to the table in a big way. The spot market is very thin. The fact that we have such a thin market and such high interest rates, there's not really much of a market for carry trades or shorter term contracts that are historically sold by traders to utilities. Now utilities are just stepping up to producers. There was a few month period during the summertime where the term market was relatively quiet. There was a lot of discussion kind of in the background or off market between utilities and producers. And then following the WNA just about a month ago, we had a lot of those discussions hit, you see, pen to paper, and we had, an additional 20 something million pounds signed. I think we're going to see more term market contracts signed for the end of the year. And really, this is year one of what we expect to be probably a 3 to 5 year period of above replacement rate contracting. So we're looking at 180 to 200 million pounds per year annualized for long-term contracts. And we're on our way there to have a good first year of a multi-year contracting cycle.
And Fabi, your thoughts on the current amount of uranium contracted this year, and if you see this trend continuing moving forward?
Well, it's hard to follow up after this very complete explanation by Justin. Yeah, I completely agree with that, because there is really only so much that fuel buyers and I guess utilities can do in the downturn while they're burning up their own stock, and that is not eternal, and it's coming home to roost finally. And we're seeing, a very, very strong year, even compared to last year. 2022 was coming after the bear market for uranium, I guess you could say. For if you take long-term contracting as a separate market, from spot and from the miners and the juniors altogether, that could have signaled the we're back year, and this year has been just so much stronger. So I expect it to keep up for at least the next 3-5 years, maybe longer. Who knows, with the SMRs coming on, that could totally change the game.
Now let's talk about the spot price of uranium here. And the equities also appreciated quite a bit initially. We've seen a nice jump. and we've seen them now settle down. Equities are pulling back a little bit. So this has caused a lot of consternation, by the way, on Uranium Twitter, which is really funny because people don't seem to realize that this is a volatile market and things just don't go straight from the bottom left to the upper right. But when it comes to deploying capital in the sector, how do you overcome this sort of volatility? Do you use volatility as your friend and wait for pullbacks in price to enter? Do you dollar cost average? What's your strategy? I'll start with you, Fabi.
So I wish I could say yes, I have perfect entries as I dollar cost average very wisely and then just exit for massive profits. The reality is a little bit different to that. So whenever I approach any sort of junior mining investment, I try to figure out whether I buy into the thesis for the commodity itself. I don't just analyze company by company. There are some people out there who are very good at doing that. I want to make sure that the stuff that the company is purporting to, look for, find, produce, etc., has a strong enough case on its own. And, with that, they can be taken with the massive inflows that come in the bull market for, metals in general. So once I have that figured out, what I then do is I try to find companies that I think are undervalued compared to one another. And so, for instance, you take developers. Well, you have the benefit of looking at their different NPVs, how recent were the studies made. My dog completely agrees with me as he looks into the financials very thoroughly, more thoroughly than I do, if I say so myself. And I try to ascertain whether that company, that project is cheap compared to something else that's within that same market. Because my understanding is that, yes, a rising tide can lift all boats, but I want to, be involved in companies that have some torque. And so, for example, people usually come back to me and tell me about, Strathmore plus Uranium. When I started talking about them, the projects in the US, actually US-based companies were something that I've been mentioning for several years now, from back in 2018 with Western Uranium. It's been a thing that I really, really like. I'm really betting on the US to do something special here in this cycle. And in Strathmore plus Uranium, even though it's still a core holding of mine, was really cheap compared to some other plays. Now I think that, for example, Kraken Energy, which is not in any way affiliated with me, I own a very small holding of Kraken, but looking at the two of them, I'm like, okay, so they're both pre-discovery officially. They have, old resources and, they're in locations that are somewhat comparable. They're both in the UK. Their size, similar management, also has, I guess, the same level of experience. What are they like compared to each other? And so when I find that a company is cheap compared to something similar, then I go in and I buy it. That's how I do it. And I usually buy everything at once. I wish I had the discipline to phase it in nicely, but I'm not illuminated enough for that.
And Justin, what about your strategy? Do you generally dollar cost average? Do you compare between different companies like Fabi's mentioning? Do you just are you more of a technical? Do you take a more technical approach and look at the charts?
For us, it's definitely more influence with this particular investment on fundamentals than technicals. Technicals can help in terms of trimming profits or entries, of course, but especially zooming out and viewing weekly or even monthly charts and looking at the relative strength index is probably the primary element of our technical analysis. So, but for the most part, it's fundamental. It's looking at the broad commodity. It's looking at what we expect going forward in the short, mid, and long term. The commodity is very clearly in a bull market, which can simplify a lot of things. If you look at the prices on the screen, that can kind of become the narrative if you're not familiar with the fundamental thesis and what's happening in the physical market. So we spend probably 80 to 90% of our time, researching the physical market. So we want to know what's happening, how many pounds are being traded, who's selling, who's buying, and at what price. And we can understand what we expect to happen for the commodity going forward. And like Fabi mentioned, generally speaking, the equities are going to perform along with the commodity. Broadly speaking, of course, there's huge moves to the upside and the downside of the equities, sometimes when the spot market is doing absolutely nothing. And like you said, that can cause a lot of consternation amongst retail traders, especially that don't necessarily have a firm grasp of the fundamentals, or are trying to look for a quick win in the markets. And that's just absolutely not our approach whatsoever. So I'm in the United States, so I have to think about the tax man and long-term and short-term capital gains, which is the 12-month cutoff. So trading in and out makes the tax man very, very happy and doesn't really always make me a lot of money. So I tend to want to keep a seat at the table for the long run of this market, which I think will last for multiple years. And I add on weakness. Haven't really gotten to the point where it's been very, very clear to start taking chips off the table. There's been plenty of intracycle swings. I just hold through those and I add when the market is bloody. It's worked very well for me. I'm going to keep doing it until it doesn't work anymore. And at some point it'll be clear. And I think the signals will be most clear in the physical market in terms of taking chips off the table and finally, cashing out on this investment. I think we're a ways away from that, but understanding who is selling at what price and in what volumes in terms of physical uranium is really going to be the biggest signal for us in terms of taking profits ultimately. So dollar cost averaging works pretty well if you don't want to kind of do the work into timing the market and understanding the fundamentals as thoroughly. I manage an account for my stepdaughter. I love this account. It's far more simple and I touch it far less than my own personal account. And, every once a month, I'll go into her account and be like, oh, there's a little bit of cash there and I still like this company and it's in the red. I'll buy a little bit of that. That's literally what I've been doing. And it worked out incredibly well. And in her account is plenty of uranium along with gold and silver and some oil services stuff, things like that. But so yeah, that's a very long-winded answer of saying I just hold for the long term and buy on weakness with this investment. And there's plenty of ways to skin a cat, and I think that technical traders can time this market pretty decently. If you go back and look at RSI, historically speaking, that does tend to time intracycle tops and bottoms decently well. But then, of course, you look at the first leg of this market and it stayed overbought for multiple months. And you were in extreme overbought conditions in the RSI for, let's say, URNM. And then it had a 15% pullback and then it ran another 70 or 80%, while it stayed overbought. So trading and swing trading within this market tends to chop people up. So unless you're in a place that has zero capital gains tax, or you're an extremely good trader, I tend to just recommend tranching into positions, hanging on for the long term, understanding the fundamentals as best you can, and be ready for volatility.
I saw a pretty interesting interview recently with Trader Ferg, and he was asked the question, has the uranium train left the station? Is it too late now for people to start investing? And his answer, he said, people don't want to hear this, but it's left the station. This is not the time. The time was a few years ago. That was kind of the deadline for if you wanted to get invested in uranium and make decent sized gains. What are your thoughts there, Justin? I'll start with you. Has the train left the station?
Yeah, I think it's pretty obvious that it has. I mean, this is not a super contrarian investment anymore where the sector is absolutely hated and the stocks are bombed out and the commodities trading well below the cost of production. That was 4 years ago. That was the time, if you really want to make a contrarian bet of something going from absolutely terrible to just bad, that was then. But right now we're on the cusp of what I think could be a super cycle for the commodity. There's embracing of nuclear in a manner that we never expected on a global basis, with very few exceptions, primarily Germany. Most other countries are either already operating nuclear power plants and looking at life extensions or looking into building new nuclear. That's literally dozens and dozens and dozens of countries around the world. There's so many elements that are coalescing right now in support of nuclear energy. And when you understand the contracting cycle, the amount of pounds that need to be purchased by utilities simply for currently operating reactors, and to Fabi's point, this is not even looking at the potential of the SMR demand absolutely snowballing and leading to hundreds of millions of pounds of demand. So has the train left the station? Yes. Are we anywhere close to that quote unquote blow off top in the final innings in the investment? No. And that's really where all the fireworks happen. So this is an incredibly de-risked investment compared to the contrarian bet that was made 4 or 5 years ago. So are you going to make 50x your money? Probably not. Are you making a much, much easier bet with a very clear physical market situation, a supply shortfall, a re-embracing of nuclear, an incredible de-risked demand picture where we're looking at the largest fleet in the world in the US now has the Inflation Reduction Act, and every single reactor operator is looking at life extensions. We're looking at restarting a shut down reactor in the United States. That's never happened in the history of nuclear in this country. So the picture is very de-risked. There's a lot of upside left, but is this a contrarian bet where you're trying to buy Paladin in a penny and then see it go to $10? That's off the table pretty much at this point. But it's a much less risky investment. Still, in our opinion, multiples to the upside for the equities.
And Fabi, your thoughts as well. Is this maybe a time to be looking for those who have the knowledge, skill, and time to be looking at maybe the exploration sector as a potential for bigger gains? And do you think all of the big gains have essentially been made when it comes to perhaps the developers and the two large producers there, Cameco and Kazatomprom?
That's an interesting question, because every time I think that we're pretty close to fair value when it comes to the late stage developers, and the price moves up just a little bit more, it makes those numbers just a little bit better. And so the posts keep moving in a way that the thesis is nicely developing. I mean, it's nice for us to say now that it's nicely developing, because the price of the commodity is finally kicking up after, you know, so long of seeing that the underworkings of the thesis were actually in our favor, and we're just getting better and better and better. And finally, you see that in the price of the commodity itself, and as a result, in the price of the equities. And so I think people have to remember that there are two different things at play. One is uranium itself. And I would say that, yes, the train has left the station in the sense that it's already moving. Very, very far from it being over. I think we go higher for longer. And even if there is, and I would expect there to be with every bubble blow off top, I think that we eventually settle at a much higher price than, you know, what happened in the past. But then there is the equities, and the equities are somewhat of a different game, because they're so speculative, you know, as you go down the food chain, that you're going to get to a stage where not only, and we're entering the stage now where instead of looking at hard numbers, financials, possible NPVs, real valuations, you're talking about pounds in the ground and how many dollars to, you know, each of these resources. That is a little bit of a more speculative conversation that we have, that is moving towards bubble territory. It doesn't mean that it is exactly bubble territory, but the conversations that we have in the bear market are more about the cream of the top, the very best projects, the very best companies, and just the bare bones, who's going to make it, who's going to come into production, you know, who has the best geology, the best everything. And then as you move along, you know, that spectrum of more and more speculation, you're going to get now into this company has this many pounds, that company has, you know, many more pounds, therefore you should buy the second one, not accounting for the cost of extracting the mineral, which is, you know, this whole game to a certain extent. And then you get to the explorers, the pre-discovery explorers, and you will get to a stage where, and I've seen this in gold before, it was absolutely insane. For a very short period of time, from 2015 to 2016, people were literally typing in gold stocks, whatever had gold in the name, they would buy it, it would go up immediately, you know, within like 3 weeks, it would double. And so we're not there yet. We're just entering the stage of being a little bit more speculative. I think you're going to see a lot of companies come out of the woodworks. There are a lot of them that have been in preparation, a lot of new companies, tiny nano cap companies that are going to come out of absolutely everywhere. And there's going to be a lot of hot money in those companies. A lot of money is going to be made. Probably a lot more money is going to be lost in trying to time, the hot nano cap of the week. But I think for the discoveries, the real discoveries that are being made, say in the Athabasca Basin, they do appreciate in price quite quickly. They just absolutely explode anytime there's even a whiff of a really high CPS reading. Then you see people just bidding the price up ferociously. And so, yes, there's a lot of opportunity there on the discovery side of it, but I'm not sure that a lot of people will be mature enough to look at the Athabasca Basin, compare it to the Thelon Basin in Nunavut, and compare it to Namibia, and compare it to Niger and to the US, because the numbers are completely different. The geology is completely different. And so I think it's going to go down to what catches the hottest headlines, and that is mostly in the Athabasca Basin. So I think you're going to see still a lot of companies just going up on the whiff, the possibility of getting a really good high grade hit.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday, and I love writing it. Hit that link below to subscribe. All right, back to the interview.
Well, let's discuss physical uranium funds now, and specifically a new physical uranium fund out of Switzerland called PFYN Capital. Askar Batarbayev, the former CCO of Kazatomprom, is involved here. Do you have any initial thoughts on this fund? And, I spoke to Mike Alkin a while ago. He says he knew of at least a handful of other funds that were getting ready to launch. This might have been one of the ones he was referring to at that time. But do you expect to see more come online as the price of uranium continues to rise? And Justin, I'll go to you first.
I mean, that's what we're hearing. It's hard to speculate on how many more funds are going to show up, but it sounds like, I mean, what we know for sure is this, the fund you just mentioned, PFYN out of Singapore. There's rumors about the capital interest in this particular fund, in the hundreds of millions, potentially up to 500 million. Can't really substantiate that rumor at this point. My understanding is there's a bit of frustration in how long it's been taking for this fund to launch, and the price has gotten away. So I think that, but they'll still show up. I think the other big one is ANU Energy that's launching next year. That's based in Kazakhstan. They've already raised 74 million. They've got a follow-on 100 million raise coming relatively soon, and then potentially up to another 400 million. They're going to IPO in Q2 of next year. And that could go a long way towards consuming some pounds from Kazatomprom themselves, who are flagging that they're ramping production for the next couple of years, going to that 100% of subsoil use contracts, which is a very significant increase in production, based on, compared to this year. So this year they're going to produce about 23,000 tons, and they're trying to get to 31,000 tons. So basically like a 35% increase in production in less than 24 months. I don't think they're going to hit it, but either way, these funds are just that, they're kind of that X factor, really, because you don't really need financial buying, hedge fund buying, physical funds for this thesis to work. You just look at the basic end user demand from utilities and the expected production into that demand. That's really the math we're looking at, and there's insufficient production even with a big ramping by Kazatomprom. So all of that said, this SMR demand that's starting already for, and SMRs that are being constructed in Canada that are not expected to be producing electricity in the early 2030s, they're buying uranium now. So more SMRs coming online and being inked around the world are going to be demand in the market, but it's something that you can't quite hang your hat on yet. So you can't model it out yet, but it is there. And the physical funds are something similar. All of these funds are set up. There's Yellowcake, there's the Sprott Physical Uranium Trust, there's the Zuri Invest Fund out of Switzerland that launched this year. Then there's PFYN and ANU, and at least one or two others that are rumored to be coming in the next 12 months. all of that financial demand, plus hedge funds that don't have anything to do with any of these funds. We know, personally, a couple that are actually buying physical uranium still. So that's also there. How much capital is going to flow into these funds? Will we have risk on markets that will allow for that? I don't know, but it is there, and it is going to be something. And now we're in a situation where 100,000 or 200,000 pounds being purchased in the spot market is actually moving the price. So it could have an enormous effect on the price of uranium if money flows in to these funds, which again is impossible to predict, but it is there. And I, just anecdotally, I don't really think these funds are existing or being set up because they don't have line of sight on demand. So more than likely, we're going to see capital interest in the commodity, especially in these other markets and the Asian markets that are not there currently. It could get pretty wild to the upside if we see capital flowing into these again.
I stand corrected. PFYN out of Singapore. I said Switzerland. I believe they might have an office in Switzerland. Fabi, your thoughts on the new physical uranium fund coming online, ANU Energy out of Kazakhstan, and the continued impact of the existing physical vehicles such as SPUT?
So what I find most interesting about the financial players coming into this market is that when you have largish funds, which, in the junior mining world, $500 million is pretty substantial, right? Especially for such a thinly traded market such as uranium, such an obscure metal as well. You have a different type of buyer that will play out a very different story to the usual spike we see in metals in the normal bull market. I think this is going to prove to be a completely abnormal bull market because we see that utilities are now starting to come back to the table, starting to sign long-term contracts. We see contracting books filling up, and then you have these different people in the same market who have a financial incentive, purely financial incentive. They don't want to save the world. They don't care about, they don't need to care about nuclear clean generation or whatever. They're in it because they understand the thesis, they believe in it, and they're willing to make a bet that they can use the liquidity in their favor in order to enter and exit the trade. Now, what I find interesting about that is that while the utilities are, building or rebuilding their stocks, the financial players are coming in, and obviously they're trying as much as possible to buy quietly. Whenever we see a fund like that, retail investors go like, yes, they're just going to bid up the price. It's going to explode. And that's not their job in the market. Their job in the market is to get the best price possible, just like you and me. And so they tried to buy quietly in the market for the longest time possible. But then the spike is inevitable with the user that cares the least how much they pay for the material, which is the utility buyer, not the financial players. And so I welcome the financial institutions that are coming in and the funds. And I think that the sooner the better, because they're technically buying up pounds. And obviously these are usually designed in a different way, to spot where, they just buy up the pounds and they don't yet have a mechanism where they can also sell pounds and things of that nature. And so there will be buying and selling. There will be more liquidity, I believe. But the funny thing is that unfortunately for the fuel buyers and for the utilities, this is going to put them in a situation where they'll be the ones creating possibly a massive spike in the price of the commodity that they for so long thought would always be very easily available for a very cheap price. And so I think it's super interesting. And I think that there is absolutely no spike like the spike of desperation of people who absolutely have no other choice but to bid the price up. And I think we might get that.
Very interesting. I want to shift to exit strategies. A lot of people are very interested in knowing when they should buy, what they should buy when it comes to equities, but very few think about if this uranium bull run does unfold as they anticipate, when to sell. So, we saw in the last bull market as well, those who held on too long got absolutely wiped out. That was quite a parabolic, insane move. I don't know if we're going to see the same thing this time around, but I'm wondering what both of your views are on what indicators you watch for knowing when to sell a position. Do you liquidate a position entirely? Do you scale out? And Fabi, we'll start with you.
So I usually try scaling out. I do scale out when I sell, not when I buy. When I see that a company is comparatively too hot for its own good. So if I feel that the news that it has up to then, it has been fairly priced by the market and there's nothing really news-wise coming out that would warrant a higher price, then I do take some chips off the table every now and again. And so that's what I try to use. There have been, a couple of plays where the uptrend was so strong that I was looking at, such a massive gain that I had to start trimming my position because I didn't even expect it to go so high. I usually look at a company and I think, okay, is this still cheap? If it's not, and I can see other cheaper plays in that same thesis or market, etc., then that's when I start trimming my position.
And Justin, your approach to exiting positions.
Yeah, I think it's crucial to trim on the way up. The classic quote, I don't know who to attribute it to, but nobody ever went broke taking profits. Don't try to hang on to a full portfolio and try to time the absolute top. It'll be extremely volatile, extremely stressful, and pretty much impossible to do. So, trimming positions down on the way up, I think, is a very good strategy. As far as timing the ultimate exit, that really is only going to come down to recognizing what's happening in the physical market. You're going to want to look at the physical funds that aren't just buy and hold funds and hedge funds and what they're doing. So it's important to have a network of contacts that can communicate directly with traders that are in the market and understand, okay, the hedge funds are starting to sell down their physical uranium. That's a signal. It's of course a signal to look at the spot price and the term price. In the previous market, I think there's some analogs there that might be helpful in this market as well. So if we see money pouring into these physical funds and, or to Fabi's point, utilities just paying up for very expensive uranium, which like she said, absolutely correctly, they're going to have to do. You can't be a nuclear fuel buyer for a utility that's operating a nuclear power plant and not have the fuel for that power plant. Like, that's not an option. So even though when the price goes crazy high, they have to pay it if they're uncovered. So, and this is really kind of an interesting element of where we're at in the market right now, because over the past decade, there's been an incredible amount of complacency amongst the nuclear utilities because supply has been so abundant. And that has done an utterly complete 180. There's very little material in the spot market. There's very little material for traders to carry trades in the short and midterm market. And the long-term market is very thin, at least for the next 4 to 5 years from the primary producers. So utilities have to pay up for development of new mines and the restarting of brownfield mines. And that's going to cost money, and we're going to see higher prices out of absolute necessity for the industry. So it's not a very risky bet or prediction to make that uranium is going higher. You have to understand what these development projects need, how much capital is going to have to be invested in to bring new production online, the difficulties, the risks that companies take. And then again, they're not in this to break even when they've been sitting on an asset for 10 years waiting for the market to shift. And so they're not going to be doing they're not going to be providing any gifts and doing any favors for the utilities necessarily. The utilities are going to have to bear the burden of paying for these projects to get into development. So the price is going to go higher. As far as selling strategy, exit strategy, you just have to watch for either an extreme price spike where the spot price rises significantly above the term price in a backwardated market. Technically, we're in a backwardated market right now because the reported term price is utterly ridiculous. It's the low offer for the monthly period. So the term price right now, I think off the top of my head, is $63 a pound, and nobody is buying uranium for $63 a pound anywhere, spot or term. But it's just a price point for negotiations to start. So But really, if the market backwardates severely and the spot price starts to go up on stilts and the term price is just being dragged up by it, that's not normal. And when that happens, you should kind of have your feelers out into the market to try to recognize, okay, when is this going to turn in the other direction? Because it will eventually. With all of that said, we have a long ways to go. I think $100 a pound is absolutely a given here. And how far it overshoots to the upside is anyone's guess. There's technical traders that are looking at the previous peak and trying to put some sort of Fibonacci overlayment on the charts and say, we're going to peak out at $1,300 uranium. It's like, I'm not in that camp. But is it going to overshoot the expected, marginal cost of production? 100% it will. It overshot to the downside. Nobody was making money at $18 a pound, not even Kazakhstan, Kazatomprom. So exciting times ahead. Where will this peak out? Nobody knows. I'm not going to make a prediction, but I know where it has to go, and it's likely to overshoot where it has to go.
Well, thanks to both of you for joining us today. It's been a very enlightening conversation. Justin, could you tell us about Uranium Insider and what you do there?
Sure. Yeah, we've been doing this since August of 2019. We cover, like I mentioned, the physical market pretty extensively. We put out an extensive monthly newsletter that goes into the macro fundamentals and covers our recommended securities in the space. We have our own process for determining what we believe are the best risk reward options as far as the equities go in the space. But like I said, we focus mostly on the physical market, and we do members only webinars once a month. I do almost daily market update videos for our paying members. So far to date, we've outperformed the benchmark URA since inception by a factor of about 2.5x. And hopefully that the outperformance will continue as this next leg up. We think this next leg up has just started. We're 7 or 8 weeks into this next leg, and it should continue with some pullbacks, and we're in one of those right now. So don't expect, like you said, Jesse, it to go from the bottom left to the upper right without any hiccups. Typically in these strong legs, bull market legs for this commodity, you'll see 30 to 50% pullbacks at least once or twice within each leg up, and some much larger pullbacks with the legs down. So we experienced that leg down right from December 2021 till about 3 or 4 months ago. It's almost 18 months where we had a 35 to 60% pullback depending on the equities. Some of the small caps got hit even worse. But big cycles, the big cycle, it's a very clear commodity bull market for uranium. We think it has a lot of legs.
Great. I'll put a link to that in the description below for people who want to check out Uranium Insider. Fabi, could you tell us about the next big rush?
Sure thing. Well, the next big rush is a daily newsletter, which is free and online, where you can get a glimpse of what happened in mining today. And I also help out some companies to get the word out about their prospective projects whenever I find them worthy. And so the next big rush is the platform where you get just what's happening right now, what's happening today, what are the highlights. And this is not just uranium, but gold, silver, copper, and everything else that goes on in junior mining. And then there's also a YouTube channel and, a Twitter account that goes with that, where I comment about the stuff that I really find interesting, that I really find cheap and undervalued in this market. So that's us. That's the next big rush.
Great. I'll put links to those things you mentioned in the description below as well. Thanks once again to both of you for joining us and sharing your knowledge with our audience.
Thank you.
My pleasure. Thanks, Jesse.